leadership experience, including 3 years as the interim Keys Dean of Administration at Marquette University. Currently, he is a professor of finance and a Bell Chair in real estate at Marquette University. Dr. Eppli is widely published in commercial real estate finance, development, and valuation. Dr. Eppli also serves on the board of a number of financial service, real estate development, not-for-profit organizations, including the Federal Home Loan Bank of Chicago, and is president of the Real Estate Research Institute. Dr. Eppli received recognition from the Greater Washington Urban League and the Urban Land Institute for his efforts in attracting minorities to real estate throughout many outreach programs. Dr. Eppli earned his PhD, his master's, and his bachelor's from the University of Wisconsin at Madison. And without further ado, I'm going to turn it over to Dr. Eppli. And Mark, tell us what's going on out there.
All right, thanks for the introduction, Jay. Delighted to be here and sharing my thoughts. So for all of you who haven't heard me before, I go through a lot of slides in a short period of time, hopefully giving enough context to each. So I've got 47 slides, and we're going to cover that in 30 to 35 minutes and take your questions after that. My idea here is to provide you with a cloud of information so you can make management decisions. Oftentimes I'll provide longer time horizons, which also hopefully provides some context. At times I'll talk about politics. No, I'm apolitical in these discussions, but it is important to look at how politics can impact economic decisions. So with that said, let's go to slide 2. And so I've got really 4 or 5 areas that I'm going to cover. No surprise with any of those. The economy, real estate investment returns, cap rates, capital flows, and space markets. Let's go to the next slide. We'll start with GDP, and let's go right into GDP. Next slide. Okay, so looking back at GDP growth rates, I go all the way back to 1960. I think it provides a really interesting context. Since 1960, we've averaged a 3.2% growth rate across time. That includes the downturns. And what we're seeing right now, since 2010, since the Great Recession, we've only had a 2.1% average growth rate. It's a little slower than average. I've included several prospective growth rates as well. We're expecting somewhere between 2.5% and maybe 2.75% growth. I mentioned some of this. I provide this context because what I will talk about is growth rates in the future of about 2.5%. That's a little different from what President Trump is looking to do, and I'll explain why I think it'll be hard to hit the numbers that he's talking about. Let's go to the next slide. So the biggest portion of GDP comes from consumers. About 68% comes from consumers, and what I provide here is both personal consumption expenditures as well as consumer sentiment. So when you start looking at consumption expenditures, they're at 4 to 5%. Those are nominal terms. So if we net out about 2% inflation, we're roughly at a growth rate in personal consumption of 2.5 to maybe 3%. And when you take that times 68%, which is the component of GDP, we're really starting with consumption generating 1.75 to about 2% of growth. I think that'll continue into the future. We've got some really bullish things as far as where the consumer stands. One of those being the consumer sentiment on the right-hand side of this slide, which you can see has solidly gone back to kind of historic norms during good periods. Let's go to the next slide. The next slide is kind of important as well, and it helps feed the consumer. And what I provide you with here is the 1 to 4 family, so it's really single family mortgages outstanding. And so what I also include here are, well, first off, in looking at that, you can start to see that single family mortgages are actually below where they were at the pre-Great Recession. That's interesting. So when you start looking at a lot of the recessions are caused by using too much debt and them being debt infused, we're not seeing that here at all. I think what's also interesting is I have a little inset in this particular slide where we start looking at growth in residential debt outstanding. In between 1980 and 1990, that grew by 1.6 trillion, 1990 and 2000 by 2.3 trillion, and so forth. But then I also standardize it by what GDP was at that time. And you can start to see that mortgage debt outstanding as a percent of GDP grew at about 2% during the 80s and 90s and 4% during the 2000 to 2010 period. I put this in here because the debt that we accumulated as consumers from re-leveraging our homes really helped fuel the growth that we saw in the previous decades. What we saw since 2010 is actually a decline, and you can start to see how that might have hurt GDP growth. I think that's going to come to an end as we go forward. So if excess debt creates bubbles, what you see here is no bubble whatsoever. Let's go on to the next slide. Additionally and importantly, what we have in this slide is household debt service payments as a percent of disposable income. So what this really starts to say, as you go high, you have less money to spend and more money paying off debt. What we have here are some of the lowest household debt service payments to disposable income that we've had since this data was collected. That's important because it allows consumers to A, maybe put some more debt on their balance sheet, or B, more money is in their pocket to spend. That's an outcome of the deleveraging that we saw in the previous slide. Let's go on. The next slide really starts to look at what GDP growth rate might look like in the future. And when you look at what really pushes GDP to grow, it's really two things. It's growing our employment base, one, and it's growing productivity, two. Growing productivity is quintessential to creating wealth to individuals. You can start to see that the annual employment growth by decade, pretty much 1960 to 2000, grew at about 2 to 2.5%. The reason for that really healthy growth in the 1960 to 1980 period was the increase in the number of women working in coming into the workforce. And we also had pretty good immigration, about 1 to 1.1%. GDP growth will not come from our growing employment base as a nation and as individuals. And you can start to see productivity has fallen somewhat in the most recent 7 years. I'll actually talk about that on a later slide. So let's go to the next slide. So I think it's worth summarizing some of the slow growth discussion that we've seen in the industry or in the U.S. And it's been organized in the following way. And I think it can help maybe explain why some of this might be cyclical and so might go away, and we might have some of this growth come back a little bit, and why some of it might be structural, meaning it's going to be here to stay. So let's start with secular stagnation. So what that's about is it's excess savings with meager investment. Two great examples of that is Apple Computer. Apple has $250 billion in cash and equivalents. If you simply take that $250 billion, that would make it the 13th largest company in the United States. And it's sitting on that much cash, making almost no return whatsoever. So what we have is classic secular stagnation. A lot of savings, and they're not investing it. U.S. corporations in general are the same way, with over $2 trillion in cash and equivalents. Now, part of it is a tax play because it's sitting overseas, but that is also limiting the investment in new innovation. So that might be one explanation, and that might be going away in the future as financial managers stop looking to cut and maybe looking to grow top-line revenue. That really hasn't been a whole lot of focus overall in the last decade. Next, recession hangover. You know, financial recessions take longer to come out of. In short, we're seeing that happen with the reduction in household debt. Third is what's referred to as a statistical mirage. And what we have here is some folks, including Hal Varian, who's the economist at Google, believes that we have actually had better economic growth than being reported. It's just we don't know how to measure it. And when you start looking at it, 80% of our economy today is really service jobs. And it's hard to measure whether you had a better waiter this time, or a better medical service, or maybe even better airline service, one of those things that's been in the news recently. Also, it's hard to measure GDP when you start having things such as your GPS in your car, or Pandora on your radio, where you don't have to pay anything for that service. That is not adding anything to GDP, but it does add to your personal benefit. So the fourth one is something that an economist out of Northwestern, Bob Gordon, has talked about. In the growth that we saw since World War II is an anomaly. And I provide you with productivity gains in the United Kingdom. They have the longest time series. And if you really look at that, before World War II, the growth rate never was higher than 1%, and maybe that should be the norm. What we saw since World War II is really benefits that were reaped from electricity and automobiles and hydraulics, structural steel as well. And maybe we've gotten the big things behind us and we don't have good growth in the future. I tend not to agree with that myself. So going to the next slide, in a quick summary of the positive and negative factors for about a 2.5% growth going forward. First off, the consumer remains confident. So that's going to account for the first 2% of growth. Can we get that other 0.5% from lower taxes and maybe consumer spending more? Or the promise of deregulation, giving business leaders confidence to start investing? Or the possibility of repatriating some of that, what I call internationally sequestered retained earnings that I mentioned earlier. But there are some negative factors as well, and one of the big challenges might be disruptive events. And these disruptive events can come from one of many different international sectors. I don't see it domestically unless we start talking about some of the, how shall I say, the President Trump not necessarily following domestic and international protocol that might assist in some of that disruption. But one of the other negatives is limited migration to the United States. We don't create enough new population to maintain our job growth. We do need some immigration. From the erosion of the middle class through automation and a lack of continued productivity growth. Quick summary of GDP. Let's go on. From there, I'd like to talk about employment and interest rates. It figures right into GDP. Let's go to employment. So when we start looking at employment, it's worth noting that in 1960 on this slide, there were 54 million people employed in the United States. Today, that number is 145 million people. So the employment base has almost tripled during that time, so that we've had 133,000 jobs created. We should really try to look at what the denominator is as far as a percent growth, and it's much larger today. Since 2010, we've grown jobs by almost 200,000 a month, 197,000, which is kind of weak given the base that we are currently working from. Let's go on. While it's been somewhat of a weak growth rate, it has been a long-term growth rate with employment, which is really quite good. I provide you next with a slide on unemployment rates across college educated, high school educated, and no high school degree lines. The challenge here is the college educated or higher unemployment rate right now sits at 2.1%. The concern there is as you start getting to that lower percent, you're going to see talent move from one company to another and demand higher wages. About 60 to 65% of everything we purchase is wages or labor. And when we start thinking about that, if we start pushing wage rates higher, that will push inflation higher. Let's go to the next slide. When we start looking at labor, what we saw and what I mentioned earlier on the left-hand side of this presentation is labor force participation rates really growing nicely through the 60s and 70s. That's women entering the labor force. What I have on the right-hand side of this is that the women entering the labor force really pushed growth rates, GDP growth rates, through new employees. But since pretty much 1990, that stopped. And we've actually seen a stagnation and even a reduction in the workforce participation. The reduction is largely coming from unskilled labor. Next slide. When we start looking, the employment roles in greater numbers now, because they entered in greater numbers, keeping this average so it's a aggregate. The challenge here is you can start to see that survey is approaching, and at times has even been over a 4% salary growth rate. I think this will push the Fed. So the Fed was pushed to increase interest rates yesterday, and that'll continue to push them because labor rates will push inflation rates in the United States. Let's go to the next slide. From there, when we start looking at that push right now, when it comes to interest rates, we have an interest rate, a 10-year Treasury today at about 2.16%. When we start looking at that 2.16% and inflation at about inflation rate over the coming 10 years. I think that might be a little bit skinny for the next several years. Focusing at the markets are focusing on the positives. I worry a little bit about ignoring some of the negatives as well. So in summary, on the next slide, my comments here are that the job market is tight, and to maintain and retain talent, you're going to have to pay more. We have a 4.3% current unemployment rate. We've got 80 months of month-over-month job growth. We've had almost 16 million jobs created in the most recent expansion. While it's been a slow expansion, it has been the largest as far as number of jobs. This next one is stunning. I don't know how many of you follow the unemployment claims, the weekly unemployment claims, but for 2 years now they've remained under 300,000. That to the end of 2017, and and risk spreads as well, as I think there's a little bit of a Goldilocks view of rates right now. Not a big push. And I also should share with you that I haven't always thought interest rates would increase. And then next slide. So working on some research with a colleague. See here in front of you are rolling 7-year holding period returns. So if you start in 1987, you go for 7 years to 1994 first quarter, and we keep on rolling that forward. What were the 7-year holding period returns? So it's your total rate of return, not unlike an internal rate of return. And you'll start to a lot of suburban office that has not well. Slide, please. So if you bought real estate, or you bought this index, which you can't buy the index, of course, but you bought real estate, you always had a positive rate of return of 2% or more. So that's nice. There were no losses. And from there, you'll start to see as well that we did have a little bit of a tough time in the 1993-94 economic downturn. What I'd like to do is go to the next slide, which is the same 7-year holding period return. But what I do here is I break it into the NCREIF income components and appreciation components. What you'll see is that the income component was really stable across time, making real estate an interesting and low volatility investment. You'll start to see it's really averaged right at about 7%. And I think that's really pretty great. And the appreciation component, which is in the red, has been positive and negative. So there's the volatility almost solely comes from the appreciation component. And you'll start to see that we had some pretty big depreciation of values if you had a holding period that ended pretty much 1991 through 1994. There's an interesting aside to this in a conundrum that I can't begin to explain, and I'm going to throw it out to you all as a question. What we saw during this period was cap rate compression, and fairly significant cap rate compression. I have exhibits on that later. But during this period of fairly significant cap rate compression, you'll note that the average appreciation return of a NCREIF, that's an institutional investor investment, unlevered by the way, was less than 1%. And you go, that's kind of unusual. So one of the things we started to do, my colleague at University of San Diego and I did, we'll go to the next slide, is saying was when we start looking at this, how were returns when we start looking at different tiers? So when I say different tiers or different markets, so I look at tier 1 market is the MM6, that's the Real Capital Analytics MM6. Those are the 6 big gateway cities, Boston, New York, Washington, D.C., Chicago, LA, and San Francisco. And then I started looking at if we can tier the rest of them in the following way. And I'm sure I'm probably creating some consternation by having some of your cities tiered in ways you don't want them to be. But what we simply did was fairly quantitative. We said, when we look at different tiers from an investor perspective, A, they're going to look at how big is the market, because that provides liquidity, and B, how fast is it growing. So what we did is we looked at how big the market was starting in 1990, and then we looked at how fast it was growing from an employment perspective through 2016. We interacted those two, and you can start to see tier 2 is a handful of cities there, tier 3 and tier 4. If we can go to the next slide, that'd be great. Looking at investment performance across each of the 4 primary real estate areas, again, using that 7-year holding period, you'll see that Tier 1 and Tier 3 did best, which is kind of interesting that we jumped over Tier 2 from a return perspective. I think what's happening in Tier 1, it's the safe place to invest, and it'll continue to have great demand, safe and liquid. But then I think a lot of institutional investors were looking for some growth. And they're looking for some growth, not so much in the Tier 2 cities, but they started looking at those Tier 3 cities that are the likes of Austin and Nashville and Charlotte and so forth. But you start to look at this, and clearly the best returns are in those 2 areas. Okay? So let's get back to this issue about cap rates. So let's go to the next slide and start looking at cap rates. And one more, so there we go, thanks. So here I pulled the last 20 years of cap rates using NCREIF data. And for the most part, it really doesn't matter which line you're representing with industrial, retail, office, or apartments, apartments being the blue line on the bottom. But you can start to see that institutional quality properties, the better properties, are now converging at cap rates that are roughly at or below 5%. So that's the institutional group. Let's go to the next slide where we start looking at a larger base of data. The larger base of data really comes from RCA, or Real Capital Analytics. They do a nice job of collecting all transactions greater than $2.5 million. And while we see a continued decline in cap rates, pretty much stabilizing, here you see, again, cap rates at fairly low rates as well. What you have with this, and the reason why these are slightly higher, of course, they're not all institutional grade properties. There's the good and the bad. It's the leased as well as the vacant. So let's go to the next slide. So using that same tiering that we had earlier of markets from Tier 1 to Tier 4, what I now start to look at is what are cap rates as of the first quarter. You can start to see they're all below 5%. Where were they 5 years ago? Where were they 10 years ago and 20 years ago? And we can start looking at the rate of change. And you can start to see that for the Tier 1 group, the difference between the current cap rates and 10 years ago is about 1%, and between current and 20 years ago is about 2%. Now it's interesting to note that a 2% reduction in cap rates from about 7% to 5% creates about a 40% increase in value. And I look at that and I go, over this past 20 years, we've seen pretty much a monotonic or a continued drop in cap rates across time, with some step up during the economic downturns. But I say this because we should have had far greater property appreciation during this period than 0.6%. I can't really explain that. I'd look forward to a discussion on that, and Jay, maybe we'll have a discussion on that. But from there, one thing that would begin to explain it are underestimation of capital expenditures that are required, especially in the non-apartment properties. I think it's an interesting slide. I think it's something that we can talk about a little more. Let's go on. So when we start looking at cap rates, I think it's good to look at cap rates from a relative value perspective. Investors don't have to invest in real estate. They can invest in other vehicles, including fixed income. So when we start looking at the slide in front of us, you'll see the blue. The blue is 10-year treasuries. You can start to see 10-year treasuries. Cap rates were always higher than 10-year treasuries. We add to that the BBB option-adjusted spreads, and by the way, option-adjusted means you're adjusting for the option to prepay, so it's taken out of there, so it's somewhat similar. And you'll start looking across that, and you'll start to see there's an additional risk premium added of about 2% each period. The green over and above that is the cap rate spread over double or BBB rated securities. So what we're seeing across time is that real estate cap rates generally exceed returns, yields, I should say, of BBB rated securities. That certainly was not the case during the Great Recession. cap rates relative to fixed income securities looking seen in the past, maybe a little bit skinnier. So I say this because that can be very important from the allocation of portfolios more into real estate versus less into real estate. This is an interesting slide. Take some time to digest it as time goes on. So let's summarize this holding period return and cap rate discussion. So first off, a 7.9% average 7-year holding period return really matches pension fund obligations really quite nicely. We'll talk about that in another 2 slides. 7% of that comes from cash flow, which is reaffirming to many investors. Properties maintain little volatility actually, and even at low cap rates, looks like real estate is still a pretty good relative value. Not exceedingly so, it seems to be about right priced. Negative attributes would be cap rates are at all-time lows. We all know that. You know, cap rates have compressed over the last 2 decades and 3 decades as I've discussed, but we've seen very little property appreciation. Kind of have to ask, what are we missing? So what I might expect is that cap rates will stabilize and actually for the first time start to tick back up a little bit as we start to recognize that investments in risky assets have a risk profile with them, and we'll have to pay a little bit more. Nothing dramatic though. Okay, let's go to capital flows, and then after that a little bit on space markets, and I will be done. So let's look at capital flows. Went to the RCA data through the first quarter of April, and you'll start to see that transaction volume is down across all property types, down 17%. And what I'm using here, by the way, so you know, it is the April 2017 year-to-date year-over-year change. So it's across all those 4 months. So I think it's a better number than simply a month. And we're down rather handily. I think that might be good from an overheating of the market perspective. I also think a lot of this is trying to adjust to what's going on in Washington, D.C. And folks are a little bit wait and see. So I don't think these will persist. I think we're already seeing second quarter data coming in with better numbers that might match those of 2017. Let's go to the next slide. So the next slide, I rip off the Wall Street Journal. And I think it's a really interesting slide. And what we're really trying to show in this slide, or what they're starting to suggest, is back in 1995, if a pension fund like Calpers, you know, the largest pension fund in the United States, California Public Employee Retirement System, was expected to have a payout or a discount rate of 7.5%, they could get it in 1995, investing 100% of their investment in bonds. But by 2005, only half that could be invested in bonds, and they had to ease into other riskier assets. By 2015, with bond yields falling to, you know, 2% or a little higher, Treasury and even triple B rates being sub 4%, to get to a 7.5% rate of return, pension funds and individuals had to broaden their portfolio, and as you can start to see on the bottom, take on more risk. So let's look at the case of Calpers in the next slide. So Calpers is the largest pension fund in the United States. They have over $300 billion under management, big numbers. I provide you with their allocation to real estate every other year from 2002 to 2016. Their annual reports come out mid-year. And you'll start to see that their percent allocation to equity real estate has increased nicely. The big jump, I think in 2006, 2008, they picked up, what was it, Centerpoint Properties, which I think helped get them a little bit more into real estate. But you'll see that at mid-year 2016, their allocation was 10.6% to real estate. They look to get that to 13%. It is interesting that that 13% exactly reflects what the previous slide had for an allocation to real estate. to start getting these pension funds to that 7.5% discount rate or expected rate of return. You should also take note of the note at the bottom of the slide. It says Calpers is reducing its discount rate, so expected rate of return they can get from its portfolio, which was at 7.5 in 2016. By 2000, I think it's 19 or 2020, that will be down to a 7% rate. So once again, I provide you with this information to give you a sense that equity investment in real estate is likely to be of continued interest to a pension fund and individual investors alike. As it creates stability from a solid cash flow, but also you have the upside possibility as most real estate leases are tagged to or inflation or are indexed to inflation or something that would approximate inflation for the coming period. So that's a little bit about equity investment in real estate. Let's go to the debt side on the next slide. So if excess debt in a marketplace starts to create bubbles, we had, I would say, a little bit of a concern when it comes to multifamily mortgage. You'll start to see that on the bottom of this slide, the blue is banks. And banks have really stepped up their loans, largely construction loans, to multifamily. You'll also see that the gray and the yellow, that's Freddie and Fannie, have stepped up as well. So we're seeing that there's a pretty sizable increase, but we've also seen a pretty sizable increase in the number of units delivered. This alone would start to provide me with some alarm bells, but as we talk about the space markets a little bit, less so. Let's go on to the next slide. And the next slide is the same, the different sources of capital, this time for commercial real estate, office, industrial, and retail. And first off, you'll note that there's not much growth there since the Great Recession. And secondly, you'll see a lot of that growth is coming from banks. And thirdly, you'll see that CMBS, the gray one, has reduced its role, in part because of new legislation that requires a 5% investment, at-risk investment by originators. So here, I'm less concerned about, how shall I say, a bubble driven by a debt growth. Let's talk about debt growth in the next slide. If we look at this next slide, you'll see that this presents real commercial real estate capital flow growth. And so it's real after adjusting for inflation, and you'll start to see that it grew heavily in the 80s, and that turned out not so well, and we shrunk. It grew heavily in the 90s, and by 2000 we have a step back in the recession, and it grew again in the 2000s, and we had the Great Recession. So you can start to see that for the most part, real estate debt has been pro-cyclical across time. In other words, it comes in greater numbers in the up markets and they pull out in the down markets. And I say pro-cyclical because it increases the volatility of that index or of that market. What we're seeing today though, and I think it's really interesting and worth noting, is that both the commercial as well as the multifamily debt rates have dropped in 2016 and 17, and we don't have a recession looking out into the future. So I think that's a kind of an interesting observation that maybe through regulation or through self-monitoring, they're reducing their role. Let's go on to the space markets. I'll share a few thoughts on, oh, I'm sorry, I blew beyond that, my bad. Next slide goes to banks being more disciplined. This is the Fed survey of banks, and you see that banks have tightened since pretty much the middle of 2015 and are continuing to tighten their lending standards. So again, speaking to that pro-cyclical issue maybe being broken a little bit. So let's summarize this on the next slide. So overall, debt increases can create bubbles. What I'm starting to see with these debt volumes and transaction volumes is the transaction volumes have stepped back, the equity sources are on the sidelines, not overly aggressive at this point. Real estate it remains a good investment because of its cash flow attributes, and bank and CMBS lenders appear to have broken some of the pro-cyclical pushing money into the market kind of at the wrong time. They seem to have broken that, that cycle from the past. Negative attributes is apartment debt levels are high, but we may need some of those. What to expect in the future, I think there's both debt and equity in the market, and they'll stay in the market. And both have been managing their risks reasonably well. I think bubble concerns have abated dramatically from my perspective. On to the space markets. As I'm getting very close to my 35, if not at my 35, so I only have a couple of slides here. First off, when we start looking at the space markets, I couldn't help but include this slide on walkability. And because what RCA is doing at this point is collecting data based on walkability. And walkability is pedestrian-friendly markets, usually using WalkScore. If you haven't looked at WalkScore, look at WalkScore. It's a Google data-driven program. But you'll start to see in blue, highly walkable, red, suburban walkable, somewhat walkable suburban, and then car dependent. And you'll start to see all start at an index of 100, and you'll start to see walkable communities have far outperformed non-walkable. And if you look at this from office as well as retail, you'll see almost the same slideshow. So the idea of infill development in walkable neighborhoods, I think are rather important today. It's walk for sustainability, walk for better body and mind. I think that's been an interesting trend and one that will continue. Over the last 3 decades. And overall what we're seeing is these very nicely right at rates that are sustainable, obviously with the exception of office, and maybe even with the industrial being at a point where that it is too low, creating some very tight markets. Let's go to the next slide and start looking at NOI as well. So when we start looking at NOI or net operating income, I provide you that same 30-year horizon on the left, but on the right, I do for each of these property types. And once again, what you see is kind of what I call it a mean reverting, nice level of growth, around 3 to 4% across all the property types except industrial. Industrial is growing quickly. Especially well-located industrial is growing more than quickly, almost at rates that are starting to become alarming. So I think this is an interesting slide. We're seeing great income growth, making real estate an interesting place to be, even if cap rates step up a little bit. Let's go to the next slide. So that's kind of the demand for space. Let's talk about the supply of space. The next 3 slides are the identical slides presented 3 different ways. So it's instructive and intended in that way. So what I have here is construction put in place by each of the 4 or 5 or 6 major property types. When we look at this going back in time, you'll start to see right now you go, ooh, that $188 billion average, and this is not adjusted for population, it is not adjusted for inflation. Looks like we might be running a little hot right now. One thing that's worth noting is that in 1993, there were 109 million employees in the United States, but by 2016, there were 146 million. So you go, oh, we got a different employment base. It's grown by 34%. Additionally, inflation grew by 51% over that time horizon. Should we not account for these things? It seems reasonable to do so. And that's what I do in the following 2 slides. Let's go to the next slide. So in the next slide, I look at real construction put in place. So let's adjust for inflation. That's that 50%, and you'll since 1993. And all of a sudden, you start looking at this, you go, yeah, we're kind of in a reasonable place. And let's go to the next slide, where we adjust for both real inflation, 1, And number two, for population growth. Population growth is slower than employment growth, so it's a little more modest way of looking at this. So when we really look at adjusting it for real estate per person and real estate on an inflation-adjusted basis, and I'm adjusting inflation using PCE, which is lower than the inflation rate we're seeing with construction costs. So I'm being hopefully thoughtful and I want to say conservative on this. You'll start to look at this and you go, we are not oversupplying the market place in real estate today. So I think when we look at the demand, it looks like it's out there as we have good NOI growth, and the supply seems to be, it's being added in reasonable ways. Once again, concern about a bubble or excess, I do not have. So let's summarize this, and I'll hand it back to Jay after this next slide. So overall, the economy will be able to maintain a 2.5% growth rate. Not much more than that because we don't have new employees coming in and great productivity growth, but the consumer confidence in purchasing by consumers will help fuel a 2+% growth rate. It won't grow more than 3% because the governor being, we don't have that many people entering the job market. Number two, because of this tight labor market, I believe inflation will consistently stay above 2% over the next set of periods. And that consistently staying over that will help the Fed continue to increase the Fed funds rate into the future and maybe push longer term interest rates up a bit as well. From there, commercial real estate. I think there'll be a little bit recognition that there is some risk with commercial real estate, maybe pushing up cap rates by a little bit. But what we're seeing is really solid income growth, which will offset that, such that prices will be sustained over time. Next, from there, commercial lenders seem to be not pushing a pro-cyclical view from a cash flow perspective, keeping at bay the possibility of a downturn in a bubble. And like I say, commercial property demand will continue to grow with this slow economic growth. That's everything I have. Jay, let me hand it back to you. And I think you're accumulating some questions with Lindsay. Sorry, I probably went more than 35 minutes. It's probably closer to 40.
No worries on going a little bit longer. It was all very informative, and we do have a few questions. So let's kick those off so we can end on the hour. One of the questions that's coming up is your comment around the unemployment rate being low, and also the fact that there are very few people to enter the workforce. So a lot of historical commercial real estate of all types has always been built around job growth. So I'd like to get your thoughts, if we have few workers entering the workforce and unemployment being so low, where will all these jobs come to fill these offices, warehouses, and retail stores?
Yeah, a great question. First off, I think current administration is not positively predisposed to immigration, so it's not going to come from there in greater numbers than it has in the past. In the past, the United States has grown by about 1.1% over the last 50 years. Last 10 years, closer to 0.7 or 0.8%. I expect that to fall. One thing we do have, and I'm on, I think it's slide 14, the labor force participation rate, it fell off a little bit. And what we have is the possibility of growing by a couple of percent as we engage workers who have not been engaged in the marketplace. Thanks, Lindsay. And that would be the left-hand side of this. And I think we have the possibility of growing back to something closer to an 85% workforce participation rate for the 25 to 54-year-old workers. As more interesting jobs come online and jobs that make it worthwhile to actually come out of maybe being dad at home or mom at home and get back into the workforce.
Excellent. One of the other questions that, certainly you touched on, but I think maybe we should expand on, is sort of the combination of, the aspect of most of the political talk is we need 4% growth to make the different proposals that are, certainly in the United States, that are on the table make any sense. And, most people are saying, except for maybe the Washington groups, are saying that's impossible. Would love to see your thoughts on, is 4% growth attainable to do what our Treasury Secretary and our President would like to do with some of their plans?
So there's a couple of hopeful things in there, and it would happen and somewhat slowly and across time, even if moves were made today. One is deregulation. Deregulation on banks and others could allow individuals to be more effective and more efficient and more productive. And as we become more productive, because we don't have to do regulatory reports, among other things, all of a sudden we have better growth. That's one of the true tenets. So that could truly be helpful. Fewer compliance people being hired would be a great example. Compliance doesn't add to the bottom line, but it adds to, or add to revenue, but it adds to expenses. So I think the regulatory environment is one that would be a very, very positive. And then I think from there, a tax. So I think if we make a little bit more money in after taxes, we might work a little bit harder. Also, if we have a little bit more money in our pocket after taxes, we are likely to spend it. That would create some growth. There's a bit of concern. That one's a double-edged sword, because that could simply be inflation, by the way. So we have to be careful that that actually is growing. So those two things could help us grow beyond the 2 to 2.5 or 2 to 2.25% growth we've seen over recent quarters. But if you go back to past administration, the Bush administrations and others, they touted some of the same, and it really hasn't worked out that way. So again, I'm not making a political statement. I'm more making an economic statement around whether or not a 4% growth rate is likely. And I would say, well, we might get 1 quarter of that, but from a sustainable point of view, on a year-over-year basis, even 3% would be a stretch.
Got it. All right, staying on taxes a little bit, because certainly there are quite a few people, both institutional owners on our call and also a lot of private owners on our call. There's all kinds of different talk about the 1031 exchanges, and there's been lots of different studies and predictions on what effect that may or may not have if they were to eliminate it from the tax code for real estate. Would love to hear Dr. Eppli's thoughts on that.
Yeah, yeah, I read this morning's paper as well. I guess it was yesterday's, where the 1031 was highlighted, I believe, on the first page of the Wall Street Journal. And the Real Estate Roundtable put forth some pretty dire suggestions. I got to say, I wouldn't agree with that. Certainly, certain segments of the commercial real estate industry would be hurt. This whole trade of the single asset buildings, the Walgreens leases and buildings and so forth, that industry would be hurt. And as would the transaction business be hurt a little bit as well, because you will hold on to something longer because you can't get that tax shelter benefit. Many people hate paying taxes, so that real distaste that they have for paying taxes will have them holding on to real estate longer and not transacting as quickly. I don't have the same thought. It might be a small impact. I would tend to say it would be almost not noticeable. So I guess that would probably be against what some on the call would like for me to say, but that's what I feel.
Okay. Let's, since we're running up against the hour, let's go back to with our last question. There's been quite a bit of interest, Mark, on what you touched on, the Apple cash overseas, and to put together a few questions that we've gotten. If you look at Facebook, Amazon, Apple, Microsoft, Google, They have a huge effect on the S&P 500 and the NASDAQ. And what are your thoughts on how, whether they bring cash back or invest, the effects these, let's say, heavy tech companies might have on the commercial real estate sector?
Yeah, so overall, as many of you know on the line, generally speaking, tax rates have come down globally, corporate tax rates, and in the United States, it's largely stayed the same at around mid-30s. We also require taxes to be paid on repatriated dollars, so it's a little bit of a double tax on them, and so they're not sending it back to the United States. And so a lot of that $2 trillion that I mentioned sits abroad. I think some of the proposals, and this is where some of the really good stuff could come from, the policy proposals by the president's administration, if we can bring down some of this corporate tax rate, or maybe even have a separate accommodation, I think some of that money could be easily repatriated. Because it looks like that not only are they making a lot of money in allocating that outside of the United States to reduce tax liability, it's sitting there, and they don't have much of a great place to invest it outside of the United States as well. So I think that's interesting. To be able to bring that back, I think would be nothing short of huge. It'll provide a huge push for investment in everything from infrastructure, among other things. So I think if I were an administrator in Washington, I would try to narrowly focus on that and worry about the bigger picture stuff later, because that could have quick impact bringing those dollars back to the United States. I think that's an important thing. So far, they haven't gotten far.
Well, excellent. Well, on behalf of NAI Global and our over 400 offices, Dr. Eppli would like to thank you for joining us today. The feedback we're getting is very informative and very timely. And for those of you that are still on the call, the slides and the recording will be available tomorrow when it'll be distributed. And we wish everyone all the best with the summer coming up. And we look forward to our third quarter call, which will be September, October time period. Thank you very much.
Thank you.